Good afternoon, everybody. My name is Jane Cooper. I'm an export finance advisor for UK Export Finance. Now, UK Export Finance is the government's export credit agency, and our specific remit is to help businesses of all sizes who either have the potential to export or who are exporting and want to take it to that next stage. Now, we work not only with the business themselves, but also with their particular bankers or brokers or any intermediaries who may be helping them in arranging finance or arranging credit insurance. It's important to note that as a government department, clearly we offer impartial advice. We will work with any bank or financial organisation which is signed up to our master agreements, and our advice is provided free of charge. Now, we talk to you about bank solutions, but we can also offer a range of non-bank solutions also if if for whatever reason your bank is unable to assist. Now, I am one of 24 advisors based around the country, and the reason that we have the regional presence is because we are each well versed in our own particular area of what grants, what schemes may be available, and what particular local skills may be available to you. So if you, recognising that this is a national event and your business may be based elsewhere, I will give you my details at the end, but you can refer to our website and actually find out who is your export finance advisor for your particular region. As I say, we should all talk the same story about what our core products and services are, but we do have that regional expertise and knowledge that we can bring to you. Now, what I specifically wanted to do was to talk about how we can help you with financing solutions and also payment protection solutions. But bringing into that, I just wanted to highlight some other risks that you may face as an exporting business. Now, I think each of these in their own right would be worthy of a separate discussion, but because they do touch on payment risk and also financial risk, I just wanted to mention them briefly here. Now, clearly, if you are about to develop a new trading relationship with a business that's overseas, it's very different to setting up that relationship with a UK-based business. First of all, if you know nothing about the business, you have the immediate issue of trying to find out about them. What's their creditworthiness? What's their financial standing? Would they be good for payment? Again, in the UK, you may know a little bit about their business by reputation. Going overseas, perhaps not so easy to do. Now, that's important because when you start to negotiate contracts, when you're trying to land that lucrative contract, part of that negotiation may extend to credit terms. Now, clearly, if you're sending your goods down the motorway to London or up to Scotland, they can be there within the day. If you're actually packaging them up and sending them abroad, there's a much longer delivery period there, and that will itself will just impact on your trade cycle, which will then impact on the credit terms that may be available. That, in turn, will impact on your funding, because clearly if you have a much longer trade cycle, you need to have sufficient working capital available to be able to support that trade, while you're still carrying on your domestic business as well and being able to pay your bills in the domestic environment. So also coupled with that is looking at the countries that your customers may be in, and realising that it's not the same as operating in the UK. There are a number of things to overcome, and I'm sure you're well versed with different cultural, language, legal systems, but it's also the country risk that you would need to consider. Now, recognising that things can change quite quickly in the world, you just need to be mindful of any occurrences that may impact your commercial contract. If there are any trade embargoes that should happen, any political events, anything that may make it illegal for the currency to actually be transferred out of that country to pay your bill at the end of the period. So it's just being aware of that. Now, another angle that may impact on financing is any unforeseen costs. And again, my colleagues in UKTI would be the appropriate people to advise you on this, but it's just worth bearing this in mind. Import duties in countries that you're unfamiliar with may really impact on your margin. And there could be other unforeseen costs as well. Incoterms, for example. These are the basic terms for which you may include or which you should include if you're providing a quotation for a potential customer, or then if you're invoicing. Now, these are important because they determine which party is actually responsible for the risk of the goods and the transportation costs of those goods. And so that can impact greatly if there's some misunderstanding about those. As I say, but colleagues in UKTI can provide you with more information about those areas. Now, the point of currency that I've put on there, and I can talk more about currency risk later, but again, it can have an impact on your competitive position. So if you're looking to export to Europe, but you wish to really stick to your guns and you wish to quote in sterling and you wish to invoice in sterling, yes, you are very much protecting yourself against the currency risk there. However, if you're competing with other European countries, then they will be quoting to your potential customer in the same denominated currency, i.e. the euro. And so again, that if you're trying to pass on the currency exposure to your customer, it just could have an impact on your success in gaining that contract or not. Now, in terms of payment risk, I just wanted to use this to demonstrate to you, again, in contract negotiations, if you are insisting on cash in advance, full payment on pro forma, that's great. You're completely covering off your payment risk. But it's just trying to emphasise there that although that's the lowest risk scenario for you, for your customer or potential customer, that represents the highest risk. Conversely, if you're trading purely on open account, that may be acceptable to you if it's a large organisation you're dealing with, if you're happy with the country risk, if you're happy that you will get paid. And again, it can help because that is the best solution for your customer too. Now, within those scenarios, there are other documents, other methods that can be used to manage that risk in terms of letters of credit or documentary collections, which are slightly different. But again, if it's something that you're starting to talk about, it's worth speaking to your local export finance advisor who can help you with arrangements on those kind of transactions. Now, I particularly mentioned foreign exchange risk here, again, because of the impact it can have on your financing requirements. So I'm sure you're all aware of what would happen potentially for trade or if there's an adverse movement in a currency that you're dealing in. Now, some people may think, why bother with trying to protect against that? We actually had quite a nice profit from favourable exchange rate movements last year. And that could be the case, but as long as you're aware of the risks. However, the prudent approach would always be to recognise that you're actually in the business of providing or selling housewares or giftwares. You're not in the business of sort of playing foreign exchange markets. So it would always best to take advice and perhaps take some action to protect. And I just tried to demonstrate there what the impact could be if you were dealing with, for example, a US dollar denominated contract. Just what a slight 5% movement in the exchange rate could have on the sterling equivalent that you would ultimately receive. Now, again, you may feel that that's an acceptable risk to take, but if your goods are very finely priced, or if you have a distributor in there or an agent and you have to pay their fees as well, just that simple exchange rate movement could completely eradicate your profit on that transaction. So what can be done? A couple of things really. First of all, the most simple method to manage this, and it depends on how your business operates, is you could open either a dollar denominated or a euro or any currency account. Now, you could use this then to match any payments that you may have to make in that currency against your receipts. Again, this could be particularly helpful if you have a distributor or an agent working for you. What that would do, it would eliminate the need to have to keep translating the currency from one to the other. And potentially the only point you would need to do that is if you have an accounting period that ends during that time. So I'll come back to that later on though. If I can, I'd just really like to talk about how UK export finance can help businesses with exporting. First of all, it's important to recognise that as a government department, we are not in the market to compete with private sector providers. So if there's an insurance solution or a financing solution out there, then we will help you find that and identify that provider. However, particularly with credit risk insurance, if there is a gap in the private market, which often there can be if private insurers aren't prepared to underwrite transactions in particular jurisdictions, we will then try and help. I mean, clearly there are some certain markets where perhaps there are economic sanctions in place where we wouldn't be able to support, but the perhaps more challenging markets where the private market doesn't have an appetite or their appetite is restricted, then we can usually find a way to help you with that. In terms of financing, we work, as I mentioned earlier, with your bank. We don't actually provide funds directly to you as a business, but what we are able to do is to provide your bank with a UK government guarantee for perhaps up to 80% of the facility. Now, if I try and sort of put some numbers around that to make it a little clearer, if you have a facility that perhaps is ring-fenced for your export activity of, say, £100,000, and you land a large export contract, or a couple of them come along at the same time, what UK government doesn't want you to do is to turn those away because you feel you haven't got financial capacity to fulfil them. What we would like you to do is to talk to us, and we can, in conjunction with your bank, look at trying to extend the bank's risk appetite. So take that £100,000 facility. If we can provide a guarantee for up to 80% of that, that could potentially increase that to £500,000 without any risk appetite for your bank. Now, one of the key benefits for this for you as an exporter is that there is absolutely no charge for us providing that security. Because we are sharing the risk with the bank, we actually share the fees with the bank also. Now, similarly with that product, we also can support any contractual bonds that may be required. Now, an example of this could be if you are dealing with a new customer, for example, and you, say, require a 30% to 50% deposit up front with an order. They may be happy to do that, but they may require an advance payment bond in return from your bank. So if you fail to fulfill that order, they can make a claim and they can be safe in the knowledge that they will get their money back. Now, that works very well, except in some situations, the bank may wish to sit on that cash as collateral for issuing that guarantee. What our UK government guarantee can do is act as replacement security. So the bank then will release that cash back to you as a business to give you the working capital to enable you to fulfill that contract. Now, again, depending on what your product may be, particularly if it's electrical goods, that kind of equipment, you may have some warranties that are required. Now, by their nature, these will be a little bit of a longer term as well. And again, bank may be happy to support those kind of contracts or those guarantees that are required. We can also provide guarantees to support those. So any kind of contractual bond that you may be required to enter into. Now, I've mentioned there how we work with the bank. There may be some circumstances, however, where the bank may not have a risk appetite. In that situation, what we will have is available to us knowledge of what's available locally in terms of grants that may be available for your specific industry or type of product, or other non-bank lenders who may be able to step in and help you. So again, we can work with you there to try and find a suitable partner for you. So really, the key points to focus on there is that for our bank-based schemes, we are completely impartial. As long as your bank is signed up to our master agreement, we are happy to work with them, but there is no cost to you as an exporter. We, as a government department, UK Export Finance, do not require any security to be provided. When you're dealing with your bank, they may have their own banking arrangements in place. They may require security by way of director's guarantee to support the unsecured portion. But we would work with your bank to work out the best possible structure for that particular transaction. Now, the way we would operate is that your bank would put the facility in place and go through their own credit process. Your bank would then apply to us. They would work with you in collecting all the details on our application form, but your bank would actually apply to us for that support. So it's worth bearing in mind that if you have sort of transaction that is looming, it is definitely worth talking to us at the earliest opportunity, simply because there are two distinct credit processes to go through, and it may not always be that easy or simple to put things in place at a moment's notice. Similarly with the credit risk insurance also, it's worth talking to us at an early stage. Now, the point, just to re-emphasise, what we're not looking to do is to compete with the private market on the credit risk insurance. Now, you may already have in place debtor insurance or whole of turnover insurance with a provider. If they aren't able to secure a particular jurisdiction to where you're selling, then they would normally be quite happy to carve out that particular contract and allow us to provide cover. Now, clearly there's a cost involved in that because there will be a premium to pay as a normal insurance policy would be. And this is where the benefit would be of talking to either us or your broker at an early stage. What we are able to do is provide you with just a simple one-page form where if you can give us the scant details of your transaction, the country where you're going to, we will look at that and try and get back to you very quickly with just what the likely premium range would be. Now, the benefit of that is it gives you an idea of what the potential costs could be. We don't do a full due diligence on your purchase at that stage, so it's not actually binding on our part, but at least if you're still in the early process of talking about prices, you may be able to recover some of that premium within your contract negotiation. If you feel that that's something that is appropriate for you, then we can proceed to full application. Now, we can accept applications for insurance direct from businesses, or we can work with your appointed broker. As long as they're registered with us, then that's fine, we can work with them. And we would encourage you to do that because your broker would actually look at your whole insurance arrangements. They would make sure that our policy actually fits the terms that you need and that there's no conflict with any other general insurance there. So just to recap, we are completely impartial. We're not looking to compete with the private market in terms of either finance or credit risk insurance. But what we will do is if there's lack of appetite, we will do our best to try and plug that gap, or we will try and work with you to find a partner who can help.